Hey, welcome everybody to our favourite scalping day of the whole month. It's NFP day, and it's a weird one. Welcome to the Mohawk Forex scalping group, live. We go where no other traders dare go. So yeah, we've got NFP, the jobs news coming up in about 25 minutes. Obviously, this is embedded in with all what's going on with Russia, Ukraine. We've got high inflation everywhere. The range of the result is crazy, between 300k on the low side up to 600, 700 on the high side. Again, nobody knows. My FX book have got it printed as expected of 490. We know historically the last 6-7 months it's been nowhere near this. So we're going to scalp the hell out of the volatility of this when the result comes out. And gold is going to be our chosen one, even though gold's been highly volatile this last week or two, and we're stuck mainly with the US 30 and DAX. We'll have a look at US 30, but myself, I'm going to go in on gold, and we will just wait for the report to come out, have a check on the RSI, and go with the trend. Counterbalance, once it hits one of our levels on the points of interest, then we'll take the reverse trade. Job done. That's it. Not messing around. We should be done hopefully in the first. We want to be done in the first few minutes. That's our trading done, and then we'll settle back and wait for the NY Open and do the same again. So, like I say, usually with gold, we would trade the reverse, i.e. the news is worse than expected, we'll look to buy, and vice versa. But at the moment, the way things are, that's not a guarantee. Wish it was. So we'll just look at our RSI, our scanner, and have a look and see where it's going to take us, the direction, see what kind of spike we get, because we usually get a spike in either direction before the result gets printed. There was a delay. Jumping on that initial spike, and then, like I say, jumping on the pullback, the plan. And as you can see, we've got heavy resistance levels on our chart. Yeah, the price can bounce off, and support levels down to. Here's kind of our range for NFP that we're looking at, and we'll print that into our group. As I said on previous streams, if you want to learn how to true scalp on our 3-minute time frame using our boutique axe trading system, then you go to www.mohawkforex.com and look all the information on how to join us. So yeah, we've got about 20 minutes to go. As we can see, some nice signals, a bearish signal, a bullish signal, and a winning bear one on our system already, which the guys could have taken if you just want to trade signals. And also you could have jumped in on the RSI crossing on 2 or 3 trades, 2 or 3 on each of those already on gold. We've already traded successfully DAX, and we've done 1, 2, 3, 4, 5, 6, 7, 8, 9. We've done 10 trades on DAX already. London Open, we're all winners, so we've already smashed that. And like I say, now we're looking for this, and then we'll see what happens on the Open. Again, on the Open, we usually go the opposite way to what we've traded with NFP, but again, that's not a given at the moment. Say with inflation and the Russia-Ukraine, we're just holding back. We're not jumping into any trades. We're not preempting. We're waiting for the strength to move, the volatility, the momentum, whichever, before we jump in and we get in, scalp the hell out of it and get out. And I said no pending orders, none of that nonsense showing your hand and having your stop loss hit. Like I said, you can see my levels I've set here. We use the points of interest grid system to give us areas of stop loss, the support and resistance zones if you want to walk away from the chart, which I heavily recommend you don't on NFP. You want to be trading this live or don't bother at all. See, it's on Trading View. We're expecting 490. This month was 678. The adjustment as well, and obviously we want it to go in conjunction with the unemployment rate as well. It's always much better if all these results come out the same direction. The average hourly earnings is a key indicator as well. They're expected to be up year on year, and up month on month as well. So that gives it a positive angle as opposed to a negative on this. So I'm expecting this to be higher, but yeah, look, that's just my looking at things. It's not a guarantee. This could be down to 200. It could be up to 700. Who knows? Nobody knows. That's the whole idea behind it. That's why I like it so much. We can just do our best to gauge the levels and then jump in, follow the trend. We're going with the trend. We're not trading anything magical here. We just jump in as quick as we can. That's why I like IC markets, as the broker recommend, because you can get in, spreads aren't crazy, and they're fairly quick to execute scalping trades.
My holders of my debt are saying, don't do that, give us increased dividends during this time. There is no well that is not profitable at 120, at 130. And if you're making a decision at prolonged period of time,
coffee, very good. Like I say, we're logged into Bloomberg as well. We're just watching and seeing what they're going to predict as well, just for a laugh, give us an idea.
Other companies are saying, no, this is exactly the kind of environment that we are going to increase production. And look, we didn't
say gold has come all the way back from over that $2,000 way back down to the 1900 level for kicking up again. And this is where you could have used our Axe trading system to get in on these kind of, we do all day, every day, for 5 to 10 pips for a 3-minute time frame. That's all we do. We're not greedy. We know the levels, and we can give a good idea of which levels, a high percentage of winning trades. So
to the oil companies to say, look, I know that
we've got, like I say, our breakout indicator system for those who like trading and got the time to watch charts, like trading zones. Can't really well. See here, look, signal, there's signal ball bear, and they all work. We've got a divergence as well, RSI scanner, which is also nice to have, like trading that. And we've got overbought levels and oversold levels, which aren't really that, but that's what we call them because everyone expects you to call that. But we look for continuation trades or pullbacks in those zones, and again on the RSI.
The U.S. government's going to fill that gap between now and then, and put that same 1 million barrels a day of production that we were hoping to get at the end.
We've got 15 minutes to go,
and put that out now, so that we're not replacing the private sector. We're incentivizing it and letting the American consumer benefit from lower prices between now and then.
The likes of Goldman Sachs disagree. Jeff Curry says this: the US policy use of an SPR release, a potential deal with Iran, extreme price volatility, and the growing risk of a recession next year are all exacerbating the uncertainty faced by producers, reducing their incentive to invest more. Amos, the reason I bring this stuff up is that I want to avoid this really kind of simplistic conversation that something untoward is happening in the oil patch, when you know that what happens in the oil industry is incredibly complex. Now, you've said something else over the last few years as well, over the last 12 months. I'll bring up another thing.
Verse 30.
This was November 17th.
Again, you can see here had a big drop. We traded, ranged around for a little bit. There was a false breakout on the signal here that you could have got a little win on, and a bear one that was a winner, and there's no other signal. So we're looking for a signal. See, look, if you trade on that.
We don't know what's on that acreage.
We've got about 5 pips or so. A bear and a signal here, so bear signal could be coming. Depends on the result. Like I say, it's.
I'm just asking, what evidence is there of that? You wanted to start this probe. What have you found? What evidence is there?
RSI 66 at the most. It's like no man's land, which I don't like trading. We're against some minor resistance as well. So again, this is really sat on our support line. The news is good. Could get a push up.
US government, we've been in close contact with the energy industry.
And good. As soon as we get a kink on the RSI like this, look, these are the trades we love to jump in on.
And that they feel that it has an incentive because
reversal RSI like that.
Before their production comes online.
Sell.
Because we're going to spend the next couple of years replenishing the reserve. That means that they are incentivized to continue to spend the capital
like a sell now, look,
to increase production. So with respect to Goldman Sachs, and I take a lot of issue with some of the other things that he said in that report.
Well, I've no doubt.
Yeah, and these are the peaks that I kind of look for following an RSI.
Like this to boost capex on front month Brent futures. Who would do that?
Vice versa if you're taking
WTI
the
futures
buys
front
obviously
month,
as
who
well.
would do that? You know what the rest of the curve
So many
looks like?
trades.
Why would
You know,
they
if you
make a
just
decision based
follow,
on where the front month
have the
is?
RSI set up on a separate
Okay,
screen.
I gotta tell you, they are making that decision. They
Out
have
for
announced that they're going to.
even with some
several local
drawdown like
majors
here,
who are the
stop loss
largest
would be
holders,
below here, so
and
you're still
drillers in the
quids
Permian,
in. You're still going to get some
and in
green.
other shale basins, have said that they are.
These are the
increasing
ones I like to
CapEx.
look for.
I think 25.
Half a dozen trades, winning trades already.
They're going to increase production. Total U.S. production is going to grow by about 10%.
It's going to be interesting for the Dow to see where that leads us on this time frame on NFP. Could just range, for all we know. That's why I like to go in on gold. Gold's guaranteed to move whatever.
But I want to address the point that you said, because I think the president was.
So if you're looking for zones, US 30, you're looking, we've got a breakout zone here and heavy resistance zone here.
The fact that part of the industry
we could be
is
looking at
exactly what it needs to do, and to see high oil prices,
if it's a sell
incentivizing
here,
them to bring about
which is plenty.
other companies, and we can't ignore this.
Talking
Some companies have said, and the
17
quote
pips
used
to the
in
top
speech,
side,
that even at $200 a barrel, I will not increase production.
30 pips to the
because
downside.
of, so-called fiscal discipline. That is not
Into
I'm
our
not
group.
No, I know you're not. Amos, and to be fair to you, just let me jump in. To be fair to you, that was a comment on this network. I heard it. I talked about it.
I know some people will set pending orders on those levels. That's fine if you want to risk it. Me, I don't, but you know, that's kind of a sensible level if you want to. If you think there's going to be a buy or a sell, have these as your TPs, and stop losses on the other side of each zone.
I spoke to a member of OPEC, and you can respond to that in a moment. I spoke to a member of OPEC
We're
this
pushing
week,
up now, look.
and I thought it was utterly embarrassing for
Good.
them.
Very
They had
nice
a
buy.
meeting earlier this month that lasted
Right, the
13
zone,
minutes,
look.
and one just yesterday
Broke a key
was
level,
1
now
minute
that's support.
shorter. Now, I wonder
And
if
we
it's
could
more
have
embarrassing
grabbed
for us that they're laughing in our faces and doing this.
20 pips already on
You
gold.
speak to the Saudis, talk to
Didn't
me
jump
about
in
it.
because I was
A,
talking.
is that false? Did the administration try and arrange a call?
Getting my finger ready, what, 10
Prince
minutes?
Mohammed bin Salman and the President of the United States. And B,
Logging
why
on.
are there
Watch.
meetings lasting
See.
13 minutes if we're in a massive energy crisis?
So, one, there was a call that was going to be arranged between the president and King Salman, and that call did take place. Those reports, I'm seeing constantly reports of Saudis snubbing the U.S. or I think there's an interest in certain quarters to bring about this kind of narrative that is completely false. I've been to Saudi Arabia on a number of occasions over the last several weeks, or a couple of months. On a couple of occasions, I was told what the Saudis told me on the front pages of a U.S. newspaper about 3 hours before the meeting started. And I showed the Saudis the headline so that we can jointly comment about the hyperbole of the press on this. So I would really relax. I don't think there's the relationship between the United States and Saudi is strategic. We have a lot of issues that we need to work on together. There are complexities in that relationship that we are working on. We have a lot of issues that are of common interest, fighting terrorism, that Saudi has had to suffer through over the last several weeks, specifically from the Houthis. We have a lot of strategic interests elsewhere in the region, and as well on energy. And I'll tell you that we're having very good discussions there. The press and reality on this one are really far apart. On OPEC, look, I was asked before the OPEC meeting if we had a message to OPEC, and my answer was, I have no message for OPEC. These are folks that know the industry, they know the market, they know the supply and demand. I must have a difference of opinion. We believe that, not just believe, but I can see the physical evidence that the market is short about 2 million barrels a day, if not more, from Russian supplies into the global market. That is clear to me. We can see that. Obviously, some perhaps in OPEC don't see the shortage of supply, but I can understand that it's a complex issue for them with the OPEC versus OPEC plus.
Excuse me.
They're going to have to take some time, and perhaps if you're not going to discuss the issues very seriously, perhaps 11 or 12 minutes.
Gold moving nicely.
But at the end of the day,
So we're looking at 1935 as a top side and 1924 on the low. And then we've got extensions on different support zones. Look here, heavy support's down to 1920 if it's a severely better than expected result.
On behalf of the U.S. government for the American public of releasing.
But again, you know, I'm not saying I'm going to just jump straight in as soon as I get the result. I want to see that move first. because, like I say, gold recently on the news events has been going away off the result, not the opposite, which is what we do pre-market. So, like I say, it's one of those times where you've got to change your strategy a little bit just because of the times we're in. And then hopefully when the world gets back to some kind of normality, probably next year, things might go back to normal. At the moment, you know, like I say, we're looking at high inflation, we're looking at the Russia-Ukraine situation. It's all having an impact on our normal economic calendar and how things move. So US dollar, Japanese yen is another good pair. You can trade on NFP as well. People do ask me what else they could trade on it.
On the situation right now. And Tom, it's a complex, nuanced conversation.
It is complex, but every single oil pro really pushes back against the
and also Euro USD. Euro USD, USD JPY and gold are the kind of ones, and I do US 30 as well. So it just depends how quickly I can get in and out of the trades. I don't usually like to trade multiple things at the same time. I try and just do one, scalp the hell out of it. Point. That broker's loaded up. We're all good. Like I say, the good thing with gold on this is you could trade this with $50. What I used to do when I first started out was literally just set up a separate account for trading high impact news events that I would stick $200 to $300 in and being prepared to risk the whole lot. I took it away from my main account, so I said didn't risk my main account, and we just put $200 or $300 and then go, okay, look, it's all or nothing. I'm either going to double this or I'm going to lose it, you know, but I'm not going to cry if I lose it because it's just a small part of my account. So that's a good way to do it in case you get big spikes or you can't get out of a trade because of the poor execution, lag time between you and your broker. All sorts of things can go wrong, you know, and majority of my losses I get are because of poor execution times, not necessarily because I've entered a trade wrong. But as a true scalper, you have to accept that there's always going to be a delay, connection issues, whatever. So you have to be prepared for that. So with NFP, it can be highlighted even more. So that's a good thing to do. And I say that to my kind of students is, you know, do that. Just if you've got $50, you want to stick in this, trade with $50. Go for a 0.01 lot size, 0.02, risk the whole lot and scalp as many times as you can, and you could easily double that 50, maybe more. I mean, you know, it can be highly volatile, but at least if you lose like within 30 seconds or whatever, which you can do, you've only lost 50. But it's the practice. It's the practice of the technique of the true scalping, using this system, using the fundamentals. That's what the key is. So, you know, everyone will always tell you only put into any trading account what you can afford to lose without it ruining your life or your day, you know, or smashing your computer, etc. You know, so I'm using 1 to 500 leverage, which is kind of standard for scalping, and that's what you need. So I can you know, throw in 5-6 trades if I want, positions rather. So if I do go wrong, I can enter trades, positions to counteract that losing trade. That's the way I kind of do it. I don't go in all in on one position. Obviously, that's a 50 risk if you've not analysed things correctly. So that's the way I do it. That's the way I try and teach it in the group. Give yourself an escape plan, a plan B, so you can counteract any losses that, you know, if the market decides to go against your analysis.
But it isn't great as predicting timing of a recession. Usually it takes about.
That's why you don't do high mega lot sizes. You know, you don't do Lambo lots and stuff. You do sensible lot sizes based on that fact that you can enter 6 positions and still have enough margin in your account to not get stopped out by the broker or by whatever yourself. So.
210s right now, just short of 2 basis points. Nadia, thank you. Nadia Lovell there of UBS. Tom, futures going into this one, up at 0.5% on the S&P, and the bond market yields are higher on 10s by 6 basis points.
5 minutes to go, guys. Yes.
210s still near that flattening here, 0.93 on 210s this morning. This is a joy because it is a symbol of the end of this pandemic. The University of Chicago Booth School celebrating the opening of their London platform built during a pandemic with the leadership of Randall Krosner. He's a former Fed governor and, of course, professor at Booth. Randy, it is a sign of a pandemic opening. We just spoke to Amos Hochstein of the White House, of the State Department on energy. How much of the mystery of this second quarter is about a booming nominal GDP and a booming American economy?
I think you really nailed it there, because the key issue is how much demand is there going to be that's going to be driving price pressures, given all the supply constraints that we have in the world. We have the ones from the pandemic, and now with the war in the Ukraine and sanctions, that's only increasing the supply tightness. And so that's exactly the issue that the Fed is going to be facing.
And what they face, Governor Krosner, is the idea of moving from 14.5% nominal GDP down to, let's call it 5 or 6.
30 as 30 is just caught that range.
And I guess the game,
As you can see, it's against our blue zone. These you know, really heavy kind of resistance zones that come on the chart automatically and tell me to end a trade if I'm in a trade, or vice versa, wait for a break or a bounce. You see, this is 1, 2, 3 times, so it usually means to me that it's going to come down under normal circumstances to kind of hitting our trend line, but you know, not an indication of the result, I'm sure. RSI is pointing down, look, so it's going to be interesting to see. And gold, on the flip side, if we just zoom out a little bit, RSI is going to bounce out of our neutral zone. Sat on neutral support. This is our daily pivot zone here.
Could slow things down in the second half of the year or next year.
That nice drop into the zone now, flat baseline, flat neutral support. So again, there's no indication of how this is going to play out in the news at all. So just getting TA, just watching our charts. He was smack on, 3 minutes to go. Good luck, everybody, and let's see what we can grab on this. This has been an interesting report.
Other shocks in the
Bloomberg is going to be lagging.
But we saw what happened in the late 1970s. We don't want to have to raise rates to double.
We'll be live watching the Forex book.
Fortunately, they haven't so far.
Hey.
One of the reasons that
we've got Forex Factory as well.
The 10-year is signaling we don't have that much of an expectation of high inflation, simply with the Treasury tips. But that's a fragile. That's something that's
refresh that, whichever one's the quickest.
Quickly, and so the Fed needs to act soon to make it less likely that they have a recession.
Randy, we're about
predicting 492. I'm predicting 480. So all around the kind of same area, but like I said, this last few months have been way out. So your guess is as good as mine, but we're just going to jump in on the whichever.
I think one of the things that we'll be looking at is what's happening with wages, but I don't think there's going to be enough to move the dial on that.
Oh, nice rejection. See that little rejection? Beautiful.
And the employment population ratio, which has been moving back up after falling precipitously during the pandemic. So we're starting to get more people back into the labor market, which is a good thing. And part of that is because some of the savings is starting to come down. We sent out checks to an enormous number of people. They're starting to spend that. That's coming down, and so some of those people are going to come back into the labor market.
Good luck, like
you're going to be teaching all this in
see how gold goes.
Booth or Booth London, whatever. I can't remember what the branding title is. Is any of what you did at the Fed in the textbooks?
Here we go. 51 minutes to go.
We seem to be in the original place this jobs day.
So a little bit of it is some of what we had from the past in responding to the financial crisis and what the banks in response to the pandemic. Some of that's in there, but this challenge of such strong growth, such high inflation.
40 seconds to go.
Some of that's there. But what's fun is I get to talk about some of the experiences.
Love it. All settled, logged in. Make sure you're on the right. You're trading the right thing. It always helps. I believe in the past have. I'm on gold and you trade in oil or whatever. You make little mistakes.
So I think that's something that I think what they're going to do is want to run that in the
see gold getting ready to move.
Fed did previously.
Ready.
They want to leave. They want to make the interest rate policy the main tool and the main thing that people focus on. And I think they'll gradually reduce the balance sheet. I don't think
it's worse than expected.
Partially because of all the uncertainty.
Just slightly. There you go. Gold. It's a nice little move up.
A lot of disruption there. A lot of potential disruption on other markets. So we certainly don't. The Fed doesn't want to pull out too much
See.
liquidity too quickly.
John, that's pretty cool. The guy goes over to London for a cup of coffee and he's
based
quoting
in
on.
LME.
You know how that
Wait
works.
for that pullback. Look at the RSI 56. Going to push out of the zone.
Been there, Randy, now.
Close some buys already.
Oh,
Going to get back in.
I was in London 2.5 years. I'm actually back in Chicago now because we had the official opening. It was
Bit
really
range
great.
around, beautiful.
And so I'm back in Chicago.
Going to push up that support zone. Not a big move, as they said. It wouldn't be a big move. RSI 54, neutral zone. See, and see if this is going to push up any more. Then we'll add up what we've done. We've closed about 6 trades already. See it bouncing off. Now it's dropping. The sell. Going to sell now. Going to come back up.
Even with this happening in the bond market, yields higher again by 5 basis points on a 10-year.
Get some more in there.
And the move we've seen on the 2-year last month was huge, up 90 basis points on the month.
Excellent. So smooth NFP, a smooth NFP.
And this
Look at this.
Yields pushing higher again on a 2-year, up 4 or 5 basis points.
There's the results, as you can see, mixed bag overall.
Speaking with certitude, out 90 days, John, or out even 1 week, they're
Post that into the
All
group.
I can say is it is absolutely original that we've got 6 or 7% nominal GDP in America. No one knows where we're heading right now.
Raw
Yes.
worse. So it's the closest they've come. So I grabbed some buys on that. So let me tell you what I got. One was an $8 loss. I got 35, $8 loss, 54.93. So we got 102, about $200 so far. We're $200 on. Well, on gold, I'm just going to post a group.
Got blown past. At what point does this become a global phenomenon that feeds on itself, and how much can the consumer really take?
The jobs number is 22 seconds away. The range is wide, wide, wide. It always
Look,
is.
gold, here we go. Look at that dropping. RSI now. If it goes red, obviously we're going to jump in.
The median's 490k. The number drops in about 10 seconds.
Going to bounce off this.
A 0.5% on the Nasdaq, up a 0.5% also in the bond market. Treasury yields are higher to 238.95. With your job
Go, look at it bounce back.
Good morning from Washington, John. And the numbers not quite as good as anticipated, but still strong.
Yeah, still strong.
1,000 jobs were restored.
You're going to see hit that bottom minor support zone nearly. Pushing up, look.
March, and the unemployment rate drops further than we had anticipated, 3.6%. So the labor market remains very strong in the U.S.
There's the bear break signal, US 30. So US 30 is dropping down.
And you end up with over 500,000 over the last 2 months, which is very, very strong.
There we go. NFP on US 30. Perfect. We're just grabbing and getting on that.
Average hourly earnings go up 5.6%
Nice sells.
on a year-over-year basis. That's a tick more than anticipated.
That's our signals. Gold now selling as well. So wait for this. Going to pull back eventually. You can see it's forming a beautiful. Look at that. It was a nice M. W. And
so more people coming out to look for work, more people
US 30.
and more people getting more money for those jobs. It's a good news story for the labor force, but maybe
we hit that level there.
Inflation.
RSI 25 is our re-entry point for trades.
A little less than 1 basis point. Let's whip through it. In the equity market, we stay elevated.
Sat perfectly.
On the S&P and on the Nasdaq 100. Let's call it 410.
This is nice. This is like a reserved result. And you know, there's no massive, really big spike. There's just some gentle moves.
At the moment, a little less than 0.5 basis point. I think we should just call it 0.
John, I got the old HP12C out here, and here's the number you got to focus on with a 95,000 revision.
18. I'm in profit on US 30. Just seeing what I can close on this. If I put a bit more, just closed 2 more buys on gold as well. What did we get? We've got 11.77 and 35. Another $60 on that.
Because their number for year ends 3.5, I think, for the next couple of years.
USD is going to range on that support. So this, as soon as we get some green, just see that push down RSI. If it's going to push into that 25 zone, could do, which means gold hopefully will push up, as it is pushing up on my chart.
the unemployment
I'll
rate
stick with
is
US
high.
30, just see this move.
The number of people in the labor force increases by 418,000. That's the biggest in 2 months. So a lot more people getting out there looking for work. Employment rises by 736,000. This is in the household survey, not the establishment survey. And unemployment falls by 318,000. So more people in, more people finding jobs. That's why the unemployment rate falls. And we used to call that good news. Again, everybody keeping an eye on the overall wages, and the Fed going to worry about a wage price spiral. Taking a quick look at some of the jobs that we got: leisure and hospitality, 112,000, still growing. Food services and drinking places, 61,000. Professional and business services,
Look, gold again.
102,000, and retail, 49,000. And we heard some stories
Waiting to
about
catch a bit more on that.
factories not being
Yeah,
able
we'll
to
grab
keep
that. We'll
up
grab that.
with
We'll
their
grab
orders because they couldn't
We'll
get
go.
enough
Oh, we
people
lost
to
348, but we got
create
30.
jobs
Was
in
good.
March. So broad-based gains.
We're still bashing
not
away.
as large in some categories as we had been seeing, but more categories with large
Gold.
increases in March.
Here we go.
Mikey,
Up.
thank you. Tremendous jobs report.
Been up
Tom.
now. It's like
431.
Fed
Just a
rejection.
slight miss on a headline number, but look through the rest of the report. Unemployment down to 3.6%. Wages climbing higher. In a material way, actually, 5.6% year on year. I imagine
Another
to kick
buy
off an
here.
interview with Secretary Walsh, Tom, in about an hour or so, we'll see a happy
Correct.
man down in Washington.
Absolutely. And the social good of the underemployment rate under 7% is there. It was 6.8%.
See what else we can
Was
get.
the best
If this is
pre-pandemic.
up.
We're back to 6.9%. Just a little bit of a difference there. And on a social statement with Secretary
So far,
Walsh,
we've
there's no
taken
focus
1,
on
2,
John. Yes,
3,
it really
4,
speaks to a
5,
not fully
6,
employed
7,
America, but
8,
certainly a
9.
trend,
9
issue
positions,
trend.
2 losses. The
Our
losses
friend
came
on
to
Jeffrey
$8.03, and we
Rosenberg,
won
portfolio
93,
manager. This is
54,
Stat
35,
Strategy Fund
35,
Black
11,
Jeff
30, and
Rosenberg,
20.
we'd like curve inversion
So
off
we're
of
well
this,
up.
now
We're
negative
going to see
1
if this is going to push
basis
up now.
points. Let's go back to
See how it
PE,
came.
Alan, and talk to me about the
Manipulation. And
nuances
now
and
this is the true move.
disaggregation
Let's
of
see if this is
curve
going to push up.
inversion. There's zero. There's a little bit inverted. Maybe there's more inversion. What is that nuance
I'm just going to
within
push
this
this into
boom
the group
economy?
to follow.
Well,
You know,
Tom,
it's gone the way, you know, worse than expected news.
what the markets were expecting,
Unemployment rate
and
was
that
slightly
trend that
better.
we were talking about in terms of
Anticipation the
bond market
same.
of
Your
yield
average
curve inversion.
earnings,
No surprises
again,
in this
about as
report,
predicted,
John.
and that
As
was bang on.
mentioned,
So
the
this was the
headline
key
report,
one.
the headline number of
The
this is
private
really
and the
minor. It's the
payrolls
strength
were
in the labor
worse, so
markets
that's why we
that's
took
being
buys on
seen
gold.
here again, and that's
You
the
know, got out
challenge
of the
for
trade,
Fed.
could have taken a
For the
sell
markets,
there.
as we're seeing a
Following the
little bit this morning,
RSI,
a little bit
so you
more
don't get
curve
out of a
flattening,
trade, and
it
this
is really
RSI
much
goes
more
red, and it didn't. It
about,
stayed.
as
You know
Mike
it's going
McKee
to
was
pull
kind of
back. It's in the
highlighting,
grey zone.
this
Take
is
the
good
drawdown.
news, but it's a little
Stay
bit too
strong.
much
Let
of
it
good
come
news.
back to you.
This is an economy and a labor market that's overheated.
I'll see if it's going to
The
push
Fed
back up
has
to that 64
accelerate.
level.
Lots of expectations.
Same
We talked
time,
about
we're
at the
still
top of the
watching
show some historic bond
US
market
30
and
look
really
drop. See if
financial
it's going to
market,
retest.
losses in the first quarter. This is the markets readjusting to a much faster pace of Fed normalization, and today's report
Again, this has been a weird
only
one
will
because it's so
reaffirm
slow.
that view, and that's what we're seeing with
We're
that little
you know,
bit of flattening
we've done
of
half the
the
amount of
market
trades we
that
usually would do on
Jeff, for
NFP,
you,
but
is
this
this
is
good
cool
or
because, like I
bad
said,
news when it
everyone
comes
said this
to
would be a
investing?
weird one and good
to
practice.
investing, you know, I think
But in
it's
terms
just
of our direction, it's gone
a
exactly as we
reaffirmation
said.
of our
We're now just seeing what
expectations.
else we
Not
can
good news or
grab.
bad news, but just this is what we expected, and what we expect is this is a very difficult environment for investing because of the challenges of the dual.
They've got it. That's the
aspects
closest
we're
it's
about
been
to
for
go
like a
into.
year.
We're talking about
Amazing.
the May
Really is.
FOMC, you know, the shrinking of the balance sheet, and you know, markets are pricing in a move towards a 50 basis point hiking cycle. This is a very, very dramatic turnabout. That's why you had such a negative price performance across fixed income in the first quarter, because we're waking up to the idea this is a Fed that wants to get out in front of the curve, and that means a very accelerated pace of tightening.
As
That's
you
a
can see on US
challenging
30, it broke
environment
our
for
level,
investors.
hit our
We just
TP on
saw
our
in
level
the
there,
first
if that's
quarter.
you want
When
to
we get
play
to
it.
the backside of it and to some rates,
That was a nice little
real
trade.
interest rates eventually and higher levels of yield, this will be an attractive environment.
See if it's going to push down, look.
Transition. It's a very
Gold
difficult
pushes up.
environment for investors, as we saw in the first quarter.
Do you think that it's basically a lock that we'll get to, we'll have 1 percentage point
Now we'll see,
increase in
we've
the
got
Fed funds rate by
50 minutes till the open, and we'll see what we get on the open.
You know, I wouldn't
And we'll
say
go
it's
in on
a
US
lock,
30
it's
on the
definitely
open, not on gold.
it's at
That's what we've been doing all week. We've had a 100% strike rate, including the London one today. So as this has been a weak NFP in terms of movement, we'll go back in on US 30. But we'll follow gold, but
in terms of risk-off environment, confidence shock. You know,
We've done our scalping on gold. You can see it's a nice little
tightening, which to
M
date
to W.
has been accelerated, but is still on the longer view very accommodating.
NFP,
If you had financial
really, because you know, you could have gone for the sell. We took the buy because you follow the system, you follow the strategy, and you want to be able to take
the fundamentals of the economy, what we see out of this
the news opposite way. You know, that was the bottom of that candle where you entered, where we entered buys, 27. Yeah. We'll see, we had a maximum of about, with spreads, 20 pips. And to the downside, had a drop off. Again, about the same, 22, 23 pips. The usual kind of NFP thing, but no real big massive. Now we're looking now for a big trend. See if we are going to get a bull signal to push back up.
The expectations.
That's what we're looking for.
Term premium and inflation expectations. So the
RSI is just popping back in the zone at the moment, so it's not looking. Just again, neutral support. The daily pivot.
To returns is the level of income.
Very much like to see this back up to here.
Negative returns was
and
you were starting at very, very low
level here.
Starting income. So as we fast forward, and you're at higher levels of income, it really gives you a lot more cushion to subsequent increases in interest rates, and that pace
US 30
returns
in this trade.
To repeat.
So then, what do you do on a strategic standpoint? I mean, if you're systematic, did you shift?
That one there's it hit the support. I got $12, about $17 on that. So that's all right. And why did I get out of the trade? Because RSI is messing around. It's not in that 25, and we're sat on our daily support. So again, you know, no matter how volatile things are, they'll respect these levels. Now, if it breaks this level, I'm in for a sell, of course. Again. But I'm just going to print in the group my trades for NFP so you can see.
To fixed income investing, and where do you see that strongest across the fixed income landscape? It's really in those shorter maturities. So that's an aspect of our investing that we think is an opportunity going forward, where there's more cushion from further increases in interest rates. And then in our investing, you know, our toolkit is both the kind of directional view that I just described, but also looking at things that take out direction and look in the cross section of investing. And there what you're seeing is a lot more opportunities to invest in dispersion. We invest in both the equity side and the fixed income side. And there
as gold's pushing up, this is great.
So it's shifting your mix, your weight in your
see
portfolio,
what
where
we've
you're
got.
getting the returns
And
from.
some more trades on
Less
gold.
directionality,
Bang.
directionality, as you highlighted the beginning.
3 more buys. We've got 22, 20, and 27. So that there are additional buys. All positions are now closed. I'm going to post that so you can see. So another $100.
Report. And looking at the movement off the back of this, yes, a small downside surprise on a headline number, but that's not the story here. This is solid pretty much across the board, everywhere you look. 3.6% unemployment rate, down from 3.8%. Wages higher year over year by 5.6%. Yes, more work still needs to be done there for sure. And look at the move in the bond market, Tom. Up 9 basis points on 2s, up 8 basis points on 10s. We've got an inverted yield curve. And coming up, a conversation with Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM Fixed Income to get his thoughts on whether he'd be a buyer here in the Treasury market. And later from the White House, Tom, Secretary Walsh.
We're going to open up the conversation here. Right now, let's go back to Mike McKee with his first reading where he gets a moment to actually breathe and look at the data. Mike, what is the distinction at 8:41 a.m.?
Well, one good news piece for Tom, for the Federal Reserve, is that they had put in this new framework to try to bring down unemployment for minority groups, and they were a little concerned about
1, 2, 3, 4, 5, 6.
But the unemployment rate for Black Americans now down to
12,
6.2%.
13. 14 trades. 14 trades on this month's NFP.
So getting close. That was a big drop from 6.6%. For Asian, 2.8%. Which is the lowest category of all. Whites come in at 3.2%. And for Hispanics, it is 4.2%. So everything dropping on that side. And it looks much better for the Fed in terms of having to retreat a little bit from running the.
I got in on that US 30 because of that bear signal.
Thank you.
Like I said, I wasn't going to trade it, but I trust that signal, and it came in.
The Lovelace family and what they've done for decades is truly one of the great activist managers. They activated last week, and
now we'll wait for the NY Open and go in on US 30 again. But again, I'm not preempting a direction. Not at the moment. Usually I would. Usually you would say, as US 30 is sold on NFP, that it's going to be a buy on the open. It's not necessarily going to be that, so we'll wait and see. Because it's one of the few news results that even in these times we're in that actually goes the way as if the market is open. Remember, the market is just pre-market trading, so usually with any kind of news event I would go the opposite way on US 30 and gold, but as it is, played the way, you know, news was worse than expected, only slightly, but US 30 dropped and gold went up, you know, so it actually was spot on, even if it's only smaller moves. But we broke our zone here, and if this is a neutral resistance zone, there's a chance and support. This could push back up. We'll wait and see. RSI is popping out of that zone, you see.
Still in a bit of a struggle with rates and the overall
gold doing that beautiful W pattern now.
Margins still struggling to provide any momentum to the market. So
it's going to hit our prediction of 1935. Hey, we'll watch this.
I walked down on your floor the other day. Everybody's dressed in black like it's Goth Tuesday or something. What is the struggle to guess margins in the next 90 days?
You know, I think analysts have very much had a difficult time struggling with margins for the last 6 months. It's not really specific to this quarter. It's been going on since September of last year, where they've modified their forward forecast, and then companies come in and beat that forecast, and then they modify it down again, and then companies come in and beat. So it's a lot of give and take on the margin lines. What we're seeing in the aggregate right now is a lot of stabilization has emerged in margins over the course of the last month. And that may be one of the hidden reasons why the equity market is starting to celebrate a little bit, or at least release some of that anxiety that emerged in February and March. But that said, it's still very sector specific.
Literally, we're going to trade to the market open. Like I say, there's the news on there. We've got manufacturing PMIs, but I'm ignoring all this at the moment. Usually I would trade these. ISM market always been stable, part of my fundamental trading, but it's not safe to, you know what I mean? So, like I say, it's a shame it's a mixed bag. Yeah, like I say, better expected on year on year, which was predicted. It's only 0.1, not big enough really to cause any push up. That was as predicted. So usually you would say that's a pat on the back, it pushes up. So you got them kind of counter-reacting. The negativity was far worse, so that was a push down. Unemployment rate again was better, but only just. It's about only just about as predicted. Predicted. Again, that's a neutral. The actual payrolls were 431 outside the private sector, so that was a push down. And then the participation rate was 62.4, 62.3 predicted. So all the green really weren't green. Hence why we saw the drop in the US 30 and the buy on gold. This is how you have to read the fundamentals. You know, look at the detail as quickly as you can. The more you trade like this and the more you practice it, the more it becomes second nature. So it's not always about the figures. It's always the consensus of the overall news releases that counts, not just one individual event, especially like I said at the moment, and it's kicking off in the world. Actually, it was a small trade. You can see, look, as I said, gold will try and push back to zone. It's just nicely pushing up now. RSI, we know what happens when it gets to 75. We're either going to get a rejection, which is sell, then a continuation, which is the buy, depending on where the level is. Like where it rejected out here, look where it was, sat on that zone. This gets to 75 and doesn't touch a zone, then you know it's a continuation. It's against the points of interest on the blue zone, the opposite direction.
Versus a pipe dream of the reality of corporate America.
I think it's pretty unrealistic right now.
Watch this.
Instead are telling us they can't get enough labor to support demand conditions as a general rule.
There you go, look, there's the figure. See, not as expected. 490 was 60,000 under, which is not a lot, but it's still enough to make the markets go the way we thought they would.
I think one thing you really also watch, Lisa, frankly, is top-line growth. I mean, revenue growth for the S&P 500 is still running at a double-digit pace. There still is a tremendous amount of volume sales. I think we'll see a slowdown in housing, maybe a slowdown in some of the rate-sensitive sectors that'll help rationalize overall revenue growth conditions. But we're a far cry yet from companies starting to lay off workers. For that, we really need to see much greater margin constraints emerge or top-line growth slow down.
Gina Martin Adams, thank you so much. The Bloomberg Intelligence. I don't envy at all the work they have forward here into earnings season. I think John Farrell mentioned mid-April we begin with JP Morgan. Right now I want to go back to Michael McKee. Michael, this is a bit tangential, but Gina Martin Adams just mentioned it, which is the housing economy. A lot of buzz this weekend into the weekend reading on higher mortgage rates. Does Chairman Powell care about a fully employed America and higher mortgage rates?
Well, he's looking for higher mortgage rates because he'd like to slow the housing market down. Housing is contributing more to inflation than almost anything at this point. We're seeing month after month 4/10 gains.
Bear break, D40, bear break.
Schiller were up 19% last year.
The DAX dropping.
Interestingly
Look,
enough,
jumping.
one of the things constraining builders has been labor, but they found 38,000 employees from the construction industry. And I was just looking through, I'm going to page down and get it again, the interesting number in terms of categories of...
Let's see if this holds. Could be good. Nice little bonus trade.
15,000 in real estate. So it looks
The
like
NFP
maybe one of those peak things where everybody comes into the market just as the market tops out. We'll have to see.
Well, what are you going to be looking for in April? I mean, we're dashed to a new quarter, and we've got important economic data before the May 4 meeting. Do you look at housing data?
Blue zone, you see, saying the blue zone came in.
Housing frenzy we're in, Mike?
You have to wait for, make sure there's no zones for it to hit. We'll come down. We'll watch this. It's going to be a nice little cheeky bonus trade before the open.
The Fed has pushed mortgage rates up above 4%, and we're still seeing strong growth. That should start to slow. There are anticipations of that. We'll see if that comes through before the next Fed meeting. We don't get another employment report.
And again, you just want to measure it. You can measure that where it is now.
Kind of comes 2 days after the meeting.
There's a chance of 50 to 100 points, maybe.
I can't gauge it. I look at home prices for sale.
And as soon as I get any green, I would trade. Just because of that zone, there's a chance of it bouncing before continuing. But the signals are pretty strong. You know, the signals do work. They're strong. There's always a good move usually with them.
Kind of froth, the same kinds of exuberance in the housing market that they last saw in 2006, and this is feeding into rents.
By 29, 20 down.
Of this inflation is what has so many people focused on wages. Now,
yeah, minor support, but it's still better respected. Following the system, blue zone is, I say danger zone, but it just gives you a heads up that things can reverse. Like here, look.
You know, Ira, it was such a joy to have Dominic Constant on today with his new opportunity at Mizuho. I mean, a great capture by Mizuho to bring in the guy you worked with at Credit Suisse years ago. And what I got from Dominic is it's a changed landscape. In your world, it's about higher yields. And I want to go, Ira, all physics envy on you right now. Once yields get underway, is there an inertial force where they just keep going higher?
Well, I don't think that they'll continue to keep going higher forever. But at the same time, you know, we put out a report last week where we noted that we could be in for a very significant sea change here, where this 40-year downtrend in yields is probably over. Now, that doesn't mean that we're necessarily going to regress and have a 1970 style sell-off necessarily, because I think the Fed is going to be aggressive enough that we'll have inflation expectations, you know, not go up much more from here. But we could have much more persistent 2.5%, 3.5% 10-year yields, as opposed to, you know, 10-year yields rallying 150 basis points every year, basically, for a better part of 10 years.
Ira, everyone's going to be talking about the yield curve, that benchmark plain vanilla 210 spread, the gap between 10-year Treasury yields and 2-year Treasury yields that we've been talking about all morning. It is now inverted. It is inverting further as we talk. The clear direction seems to be what everybody was worried about. Do you buy the Fed's argument that this yield curve doesn't really matter matter. And that if you look at others, particularly in terms of the very short-term debt market, it's actually looking much more constructive.
Well, so here's the thing, right? When the Fed looks, they say, okay, in the next 12 months, are we going to have a recession? Even the 2-10s curve doesn't tell you that. The 2-10s curve is more 12 to 18 months out. Will you have a significant slowing of the economy, if not a recession? And the answer to that is yes. And look, it doesn't work every time, but it's worked 5 of the last 6. So I'll take the bond market's call on that. The front end curve that they look at is going to invert, and it's going to be very flat a year from now. So I think it's all very consistent. If the Federal Reserve hikes as the market is currently priced, so 7-8 times this year, and 9 times over the next 12 months, we're going to have a completely pancake flat curve, and that's what the market's pricing. The market's pricing for the 2-10s curve to be inverted by about 17 basis points this time next year, and like I said, 5 of 6 times that's led to a recession within the not too distant future. So it's not imminent. It's not.
See, RSI's bounced out of that, you see. So yeah, it wasn't a good trade. It was just at the moment still pushed down. Not instant winner like sometimes some of these signals are. They say there's been no blue zone. And you can see why it was sat on. It was sat on our red breakout zone, which is a key level again. So you want to see price action actually break. It just flashed. It didn't finish outside the zone. Then it would have come down.
Well, obviously it depends on where the data is, I think, in the next 3 to 6 months. Because
we'll keep an eye on that and just see. At least the signal is stuck. There's a high chance of this coming back down, but it could come back into the neutral zone before down. We'll keep an eye on that.
Months ago, for sure. And service
For
sector
more
coming back is going to be a big part of that. So
back in on gold.
weren't worried
Oh,
about
beautiful.
inflation
Look at
until we
that.
started
This
to
say
see
it doesn't
services
always go
prices
your
going up,
way,
and
but it
the
doesn't matter.
large
Look at
component
that.
of that is wage gains in
Perfect.
those sectors. And this morning's
Drop
report
red.
confirms that yes, wage gains
We're
in
looking
some
for
of
a
the services
sell
sectors
on
are
gold
still
now.
pretty robust. And
Again,
that
not
means we
yet.
can have maybe,
Don't jump in.
2.5-3%
You know what I'm saying? Because
inflation
look what
more
it's sat on.
consistently than we
The
did
neutral
the past
support
decade.
and our
This is Sean
baseline.
Staley, Lisa Abramowitz and
And
Tom
it's on the
Keegan.
average
Welcome all
RSI,
of
so
you
it
on
can
Bloomberg
reject
Radio and Bloomberg Television.
out of
We
here.
wrap up the hour with Ira Jersey on fixed income and our Michael McKee looking forward to May 4
Then it can
and then
reject
on June 15
to the
is the
zones.
Fed
Wants to break it.
meetings. Mike, I look at what the
Ends
bond
here.
market
It
says,
can reject.
and what it says is big jumps and big uncertainty. How does the Fed react
If it
to
rejects,
10 basis point
then you've got
moves,
this
8
gap scalp.
basis point moves in full
Yeah,
faith
it's another
and
bonus
credit
trade.
debt?
Again, there's
Well,
another
if
10 pips
somebody,
maybe.
promises to sell a bond
On this candle,
or
2 minutes
repo
to
a
go.
bond and it gets delivered, the Fed's not going to
It
worry about it. They'll only
means
worry about it if it's a problem with the system itself. At this point, the Fed is expecting to see rates go up.
the neutral and rising. That's the issue. The market trend is neutral and rising. So telling me it could flatten out and bomb back up.
Because now
Yeah,
people
look.
are starting to think the Fed's going to have to move even
That's why I
faster
don't
because
jump
the
in.
support is really strong. The Fed doesn't worry about that, but they aren't going to worry about it unless there's a systemic problem, as there was last March. March 2020.
Does the Fed or anyone at the Fed, including their wonderful research staff, do they care about nominal GDP, or are they still wedded to 20, 30, 40 years of inflation-adjusted GDP analysis?
Well, they'll look at the inflation-adjusted GDP analysis because they can separate out inflation from that, and that's a different problem. There are people who think the Fed should start looking at nominal GDP and try to control interest rates by using that instead of the Fed funds rate or the target.
You see how it's stuck on that neutral support. This is the daily pivot.
Ira, going forward, what are you looking at
Key
in terms of
support level
data
on
that
here
would be
and
instructive
strength.
as to the Fed path? I mean, or is it
Index
really
is
baked in at this
43.
point, and we're just going to wait and see after those initial 50
There was
basis point
30
moves?
again. It's formed another blue zone. Look,
50 basis point moves, but certainly
it'll come back
50 basis
down.
point move in
We
either
might
way
be
or
able to
June, I think
still
is
grab
pretty likely.
5 on this.
But
Good
ultimately,
chance.
I think the second half
Keep an eye
of
on
the
that at
year
the
is
same
going to be
time.
much more constructive because we didn't see significant interest rate hikes. We haven't
Got
seen,
30 minutes
till the
till the
what's going
open.
to happen with the housing market, for example. Will we see a significant slowing in home sales and a deceleration in home prices significantly? So I think that right now we have to consider, look, the Fed's going to hike another 100 or 150 basis points. points before they actually consider, whether or not they're going to slow down. And by then, by the third, fourth quarter of this year, we'll have significantly more data. And it's all the data you think about, right? The payrolls report, obviously, the CPI and PCE reports are going to be of very, very strong interest to markets. And keep in mind, the market is still pricing. When you look at inflation break-evens, the market is still
the bigger
pricing
picture,
for
the Dow's
inflation
up
to be much lower next year than this year,
0.32.
but it's not going to be at
For us.
3% where we were pricing 2 months ago. We're now thinking that the inflation is going to be well above 3% at the end of the year, and that should still keep the Federal Reserve relatively hawkish.
Ira, how concerned are you about liquidity in the bond market, especially as the balance sheet comes into play?
Very. So Sean Savage from our market structure team and I have done a lot of work on this, and liquidity is very, very poor. Dealer balance sheet just can't absorb
Catch anything on this
all
gold
the selling
move.
pressure that's coming out of the market as we get these sell-offs, which is one of
We
the
get
reasons
exposed.
you're
You see, I like to
these
see
10 basis
that.
point moves, whereas before they might have been a 4 to 5
Again.
basis point move. You're getting much more realized volatility, and that's something that we think
Yeah,
will
we're
continue
in.
and maybe even
Brilliant
accelerate
move.
when the
Oh,
Fed starts to reduce.
we got
its balance
$200
sheet,
on that.
and there'll be a lot
Perfect.
more treasuries available to investors.
What do we get? What do we get? 99, 49, and 54. Yes, we got $200 on that. Perfect. Again, thanks to our Axe trading system, that was an easy
Mr.
trade.
Jersey just mentioned there about the balance sheet dynamics of the ECB and the Fed. And forget about Japan. Let's assume nothing happens there.
Again, got out before it bounced. Our trend line, as soon as I saw the RSI break, it was either going to go one way, it was either going to bounce off that, but as soon as it breaks out of that zone and we're clear, there's clear between you and the next points of interest, guess what you do? You trade it.
It's also the ECB, that sort of dueling action with very different economic backdrops. I'm just trying to square what Gina's talking about with that strength in corporate America and the pessimism in bond markets.
Nice, these are all extra bonus trades. And now we'll just wait and see if US 30 is going to break this level.
Historic 90 days we've had, and we must say thank you to our team that have just killed on getting us voices and guests to make this historic time seem
Gonna go lower.
insane. Is the uncertainty is off the chart.
25.
I was uncertain on January 1, the Ides of March. Here we are, and I'm uncertain going forward. I just don't know what to think.
And people are talking about regime change in terms of inflation, in terms of rates, in terms of geopolitics. How do we chart that out?
Our regime changes. We'll have a conversation with the Secretary of Labor, Martin Walsh. Look for that coming up on Bloomberg Radio and Bloomberg Television.
Again, it's just ranging around.
This morning. Good morning. Good morning. With equity futures.
Good morning, Jonathan. Good morning.
Q2. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is
We're already trading.
Open with Jonathan Farrow.
This little push down. There we go. Come on.
We begin with the big issue, the Fed under pressure.
How high does the Fed have to hike?
The jobs data this week inflation.
Data dependent is certainly the name of the game.
The Fed will try to be data dependent.
They go 50 in May. That's the new hike.
The markets, from a pricing standpoint,
suggest that there's a 50 basis
point. Is it going to be filled?
They're going to do 50 basis points.
Going to come down.
This is really a Fed now that is in inflation fighting mode. Inflation is going to be absolutely insane for March.
Perfect.
The Fed is very much keen on front-loading these rate hikes.
It has to hike until there's some
beautiful
kind
sell.
Of pain.
The Fed is late. The Fed knows it's late.
Call me when we get to 3% in inflation, and then they'll stop.
They do have to move pretty aggressively.
Joining us now is Mike McKee down in D.C. Mike McKee, this one looks solid.
This one is solid, John.
Gold as well. Look at that. RSI is now 31.
March as employers continue to try to staff up. 431,000 jobs were created or
great.
restored.
I mean, this is a good indication that we could get buys on US 30 and on gold on the way back. Unless this pulls back in the next half an hour.
Which brings you to 526.
Heavy support.
New jobs that we didn't know about last month.
Yeah, and it hit our PP, you see.
To last July
the NFP, which we took buys because news was worse than expected. And then, like I say, once it hits a level, what's it do? Pull back. There you go. There's your M, there's your W. Now we're forming an M again.
And we see a lot more hiring than unemployment.
Love seeing wave patterns.
Participation rate ticks up to 62.4%. The Fed wants to see that. Average hourly earnings tick up to 5.6%. The Fed does not want to see that. Where were the jobs? Leisure and hospitality, bartenders, waitresses, and people working at hotels coming back to work, 112,000. Not quite as many as last month, but when you look through this report, it's a lot of jobs created in a lot of different areas. So a broad report instead of just a couple areas. Professional and business services up 102,000. Those are the McKinseys and Boston Consultings and the H&R Block accountants, that sort of thing. Retail, 49,000. Manufacturing, 38,000. Now let's go back just before I leave you, John, and show you the problem for the Fed.
And then we just closed out 3 sales on DAX as well. Just a quick trade, $20 on that sell, just because it followed a US 30. So you go, so that spike down there. I was just watching it on the screen.
But then go all the way over to the right where wages and inflation
Saw the kink down, and I knew this zone is quite decent support. So as soon as it pushed down, it's got out, and whatever I took was whatever I took, and it was $20. So good one on that one. Gold. So you know, it's what I'm always looking for.
Mike McKee, thank you, sir. What a meeting we've got coming up at the Federal Reserve in early May. Joining us now is BlackRock Global Fixed Income CIO Rick Reeder, and a whole lot more over at BlackRock too.
Beautiful drop.
Rick, just react to this
Oh,
one.
look at that.
Wow, it looks decent.
Wow, it looks decent. I mean, the data is really strong. By the way, people, when they first saw it, said the 430,000 or so jobs was a little below expectations. You know, what people have to start factoring in is there's just not enough people to come back into the workforce. So I was looking at the data this morning. There's 1.6 million people who are not in the workforce, who were, if you go back a couple of years, when we were pretty close to full employment. And you've had this, what is that number? You've had about that number that are retired. So to bring people back in, it's going to be hard to see 500,000 jobs any of these subsequent months. There's 11 million job openings. You've got a labor market. There's just not enough people that can come back in. So you're going to start to see these numbers decline a little bit, but the unemployment rate, I think, is going to continue to decline. So it's a white hot labor market. There's no other way to describe it.
Rick, is this as good as it gets? And where does it leave this Fed?
I think it's as good as it gets from a labor perspective. I think the economy is moderating. I think you're seeing, when you look at some of the retail sales numbers that have come across globally, look at H&M yesterday, you're starting to see some of the data come off. You look at the housing market, boy, if anything was to suggest to you some form of stagflation, it would be in the housing market. So I think the economy, and this is part of why the Fed's in the toughest position that maybe I've ever seen them, is the economy starting to moderate in a bunch of ways. If you can't find the
RSI danger zone, you see in this no man's zone between
your input costs are going up, companies will start
5 and 25, so I don't tend to trade this. So again, it's protected off the level here, blue zone.
And this is why I think the Fed's got a tough job. And I think part of why I think it probably makes sense to get some 50s in when you've got an economy that's moderating, and I think they'll probably do that.
Yeah, we'll see now which way this goes, see if RSI comes back up. Take another buy, but it's got a decent resistance zone now, so see it push down. Get pushed down. It's our breakout zone here, look, as you can see. It's
so far from neutral. They're still in super easy.
We know once price finishes below or above these breakout zones, there's going to be a move. And at the moment there isn't. It kind of rejected off it both ways, so this will be.
It's not impossible, but boy, I would argue.
We've got
listen, get off
PMIs.
easy.
I'm not really taking notice off today.
QE was ending.
We're going to go another 20 minutes. We're going to trade the open, and then that'll be it for today. It's been a good 90-minute stream. Another successful NFP, slightly different to the norm, but that's what I like about trading. Nothing is predictable.
And look at what the data is doing. If anybody can tell me they know what's going to happen,
say we've cleared
situation, what's going to happen with the Chinese growth situation, what's going to happen with European growth deceleration, these high prices which tend to cure high prices as consumers pull back.
We've done 19 trades, 19 trades since the NFP, and we've got 2 losses, 17 wins. So yeah, we're getting towards our daily target, which is really nice.
Is we are, people tend to focus on the flattening of the curve in the front end. They say, gosh, short end rates have moved higher. We actually we've been investing in that 1 to 3 part of the investment grade
We'll
credit
watch
market.
gold,
So if you look
see where
at
that stacks up for the
returns this year
open,
in
and then
fixed
we're going to
income,
go
I
in
think
on
the
US
ag,
30.
after today, the ag's going to be down 6.5% or so. Things like long corporates are down double digits. Things like long treasuries down double digits. You know, I actually like owning some. You know, you got to keep your interest rate exposure down. Like, even though the curve's flattening, there's a concept of duration. There's a concept of, gosh, I just want to keep my return. If I can carry, you know, well, you know, the short end of the aggregate index is down about 2.5% this year. You know, down 2.5 is better than everything else. It's down 6 to 12%. So that's part of where we're quote unquote hiding for a bit of time. You know, get some yield, get some carry into the portfolio, and don't take too much interest rate risk. Listen, if we're going to get the next 3 months, you're going to get CPI prints that are going to show year-on-year CPI that's going to be 8-ish%. You know, that's not going to give people any comfort around, you know, a 10-year treasury that's at 240. So anyway, we're keeping our interest rate exposure very, very moderate here.
What about your credit exposure, Rick, specifically high yield credit?
So Jonathan, actually for the first time in a number of months, we've started to add a little bit. And, you know, when you get high yield back at 6%, and, you know, we like loans quite a bit because interest rates are rising. But, you know, now when you get high yield back at 6%, you know, it's pretty interesting. By the way, you know, I always think the best valuation of the equity market is you take the free cash flow the companies throw off relative to the cost of financing it, i.e. where the credit market is. And for 10 years, equities have been too cheap. Equities are not too cheap anymore relative to where the cost of financing is, i.e. the high yield market, the investor grade market. So we've been adding a little bit, again, trying to manage the interest rate exposure. But we've been adding a little bit for the first time in a while. As you're getting back to yield levels, you say, gosh, if you go over the last 10 years and say high yield at 6s into the 7s, you know, that's not a bad place to capture some carry. But again, I still think you can be patient.
Help me understand what that means for the cash position, because you had raised the cash position. Have you maintained that at existing levels? Did you use some of that cash to go into high yield, or did you rotate out of equities?
So cash is one of my favorite assets today, and it continues to be. I mean, you look at, somebody put a report out today.
See how gold now has bounced off that? Perfect.
You take the equity market, the debt
RSI
market,
comes out of the zone. So again, some people could have put a cheeky buy in on that.
In that environment. So we're still
Yeah,
running a
out
high
there.
level of cash. We've drawn it down a little bit, Jonathan, to your point.
At the bottom of that candle, the reverse look, good for 10 pips. Perfect. This is why you can just focus on one particular thing and just keep scalping it, you know.
Maybe a tiny bit of EM
And I've done, you know, best part of, what did I say? No, I've done about 30 trades today. And I've just done DAX, gold, US 30. That's it. You know, I don't need to be trading random pairs, stocks, etc. Once you've got the system down and you can follow something comfortably, the patterns that it forms, stick with it. Simple as.
They've got CPI running at 7.5%, a deposit rate of negative 50 basis points. And Rick, I'm just trying to get my head around how much repricing we need to do in a fixed income universe if Europe's on the path back to zero on a policy rate.
So, Jonathan, I mean, think about how many years we were on the show together, and we talk about, can Europe get a 1% inflation rate?
Yep.
Think about the number you just described. It's pretty extraordinary. And listen, I mean, you know, by the way, European growth over the next 2 or 3 years, we were just looking at numbers today. They
All-time
on
high.
par. The way we actually looked at estimates, economist estimates. They show, for the first time that I think I've ever seen this, European growth the next 3 years on par with the U.S. My guess is there's some assumption you're going to see fiscal spend alongside of that in immigration, in defense, it's infrastructure, climate, et cetera. So Europe could grow and could grow nicely for the next couple of years. And you've got an inflation dynamic, meaning we have some more to go in Europe. I would argue from a rate perspective, you know, thank goodness we're out of the negative interest rate scheme, which, as you know, I think is crazy to start with. But I do think we've got some ways to go. Listen, I think interest rates particularly in the U.S., the demographic and the demand, you know, why are rates still where they are? You know, global demand for yielding assets for income is still pretty high. But, you know, if you said to me, pick which side they're going, I still think particularly in Europe, I think rates have a bit more to go.
Rick, just finally from me, we have been talking for a long, long time. It does go back years
I see that the Total Return Fund won the Lipper Award for the best core bond fund over 10 years. I wanted to congratulate you and give you the opportunity as well just to talk about your team. Because, of course, it's not just about you, it's a team effort, a big team behind you over at BlackRock.
So you're very kind to mention that. And by the way, Bob Miller is, who I know you have on the show a lot, is an extraordinary driver of that fund, and Dave Rogel. And it's, I mean, it's a huge honor. I mean, it's one thing to do it for a month or so, but Bob and Dave and I think as a team, it's been a pretty good effort. So you're very kind to bring that up. And so anyway, I will say, that was what has happened.
Yeah.
And there's no less work applied today to trying to figure out the environmental conditions to operate within in these markets.
Hey, Rick, here's to another 10 years. My best to you and the team. We appreciate it. Good friend of this program. Looking forward to years still to come. BlackRock's Rick Reader there on his effort.
Gold breaking through.
Futures are positive by 0.25% on the
Our heavy support again. Look, so
with some movers. Here's Abby.
John,
4 seconds to go. RSI is going to creep down, is it?
On that strong jobs report, yields popping sharply higher, especially that 2-year yield. And despite the fact that the 210s are inverted,
Breakout zones, so be careful. Don't get caught out by a reversal. We've got a new trend line popped up here now. Look.
Still up 0.4%, even though rising yields, as you know, could call into question valuation. Speaking of higher, China tech, take a look at Alibaba, up 7.1%. This, of course, as China is considering giving U.S. full access to audits that would, of course, provide more transparency to these companies and to perhaps take away the uninvestable question. And then finally, maybe as a barometer of risk sentiment, GameStop, meme mania, up 14%. Stock futures may be up modestly, but these meme stocks continue to go. Perhaps we'll see the indexes follow, John.
Abby, thank you. Coming up on the program, President Biden ordering a record release of U.S. oil.
It's time to deliver true long-term energy independence in America once and for all. And
I'm interested to see what oil does.
Every tool at my disposal.
At US 30, see, look, it's beautiful. See, it bounced right back out of our zone. Blue zone, kink in the RSI. There, you could have taken the buy, saying captured all this. I'm just analysing other charts, but you could have done. Get an alert. You can set an alert when the RSI crosses the 25 zone to trade these reversals if you want. Again, another technique, but it does work, as you can see. Every time you can catch a reversal, if that's the kind of trader you are. I used to do that. I used to find it really hard to trade the trend. I don't know why, because I was always stuck in a trade going the opposite way, I suppose. But you learn, That's just why now my strategy is mostly following the trend, but I do like doing reversals when they're kind of, it gets these kind of zones and you see the push up. Not always guaranteed, because we know the RSI can range between these two zones for a long time, and price actions still keep going down. So don't automatically assume you're going to be taking the reversals once you get to these zones, because sometimes it could be a big continuation. By this occasion, as you can see, was the candle told you there that high. Now it's hitting resistance, could come back down again. Go ahead and double top. In fact, head and shoulders, triple top, and then looking at the W pattern.
About 3% of all the world's CO2 emissions come from shipping.
To form
3% may
this.
sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Look for. Like I said, I'm not going to enter any trades because we're 10 minutes away from getting stuck in on US 30.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is going to be interesting to see if it's going to go the opposite to what it did on NFP. We'll see US 30 dropped, and the result being worse than expected. Now we're looking at the buys to see if this is going to be going to come up here for the open. Going to clear our next level. Back up to the 34897.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months.
We're going to be going in on. So I'm in no positions at the moment. We're all out. Let's say 20 trades. 30 altogether for the day, 20 for NFP. got
President
2
Biden tapping
losses
US oil
on
reserves in hopes of cutting gas prices. Russia demanding payments in rubles. But Putin easing disruption fears, saying the following: "We have complied and will comply in the future with obligations under all contracts, including gas contracts. We will continue to supply gas in the volumes and at the prices set in current long-term agreements." Your team coverage starts right now with Bloomberg's Maria Tadeo and Bloomberg's Anne-Marie down in DC. Maria, let's start with you. Have we settled this one yet? Has it been sorted out? On the
This will
gas
have a big
prices,
impact, you
rubles,
see.
euros, dollars,
Talks
what?
for definite.
Well, you want to sort it, I want to sort it, and this has been a perennial question now for a week. And look, we now start to get some idea. We have some idea of what this is going to look like. What the Russians say is we're not going to cut the flows into Europe. We're going to continue to honor contracts. We know that Gazprom, by the way, has never been in breach of contract, not even in the run-up to the invasion of Ukraine. But he says what's going to change is that from today, there will be a ruble bank account. So the impression that we get is that European companies will send the money in euros, and Gazprom Bank, remember, this is the one financial institution that has not been sanctioned, will then create 2 accounts for its clients. One to cash in the payments in euros. The other one would make allegedly that conversion into rubles. So there's 2 things to keep in mind here. One, of course, is that Russia still gets the money from the gas. Europe continues to buy this gas. And then secondly, the impression that I get is for as long as Gazprom is not sanctioned, there won't be anything that looks like an energy oil embargo. It is very clear that the Europeans want to keep that financial line going, and what we're seeing here is a lot of political grandstanding, but in the end, not a lot will change. The swap will be done, presumably internally by the Russian Federation.
Maria, that's the situation in Europe. AMH, let's talk about the situation in the United States, and welcome back. We've missed you. Have we settled this effort by the president? How well received has it been? Will it make a difference?
Well, it does seem to be making a little bit of difference when you look at what's going on right now in the spot prices, right, Jonathan? When you have WTI off some 7% when this was announced. The issue really is, and I know you spoke to the special envoy for energy security, Amos Hochstein, is will this really bridge a gap, and then will drillers want to come back and actually want to produce more? That is domestic U.S. drillers. And the president really went after them yesterday, asking Congress to charge fees to these firms that have unused drilling leases on federal lands. So you can see a little bit of the tension. Notice, Jonathan, this is
going to be stuck in the trade around the open, so it's fine.
It is absolutely historic.
I get FOMO. It was a nice bear signal, beautiful.
Potentially, though,
As that came and stuck halfway down that candle, you could have been in.
They say this is a wartime effort.
Get out at the key levels.
AMH, thank you. We'll catch up with you a little bit later.
It was the bear one that was exactly the same.
Election over in Hungary.
And I would have taken my profit. And pips, not being greedy, I wouldn't have been stuck in any draw, and I'd have been gone back in again.
On energy, not outright bearish, but time to ease up on energy. Do you agree?
I don't fully agree with that, Jonathan. And I think energy really remains one of the better geopolitical risk hedges that we have. And if you think about oil prices, they have already eased up from some of the worst case scenarios. But I don't know if we fully ruled out the worst case scenarios from, let's say, the output from Russia. What if that's completely curtailed? I think the market is considering that we're still going to be
Gold thinking about dropping, you see.
Something like 70
The
or
pattern at the moment.
of the volume
Gold's thinking of dropping.
They're looking for a new
And US 30 is, well, it's pushing up. They'll usually go opposite, not always.
Now, energy stocks have done
Again, it's because we're sat on this zone.
this environment,
a decent
with
zone.
oil prices still continue to be at $100 a barrel, and I think that's plus, and that's our expectation for the remainder of the year. These oil companies are going to be making very significant cash flow. And by the way, when I think about the current environment, you want to be in higher quality stocks.
Price has got to pop out of that zone.
And that's actually what you find in the energy sector right now.
Mike Collins, that's the answer from an equity perspective. Can you give us the credit view?
Yeah, so Jonathan, we've been overweight generally the energy sector, including a lot of the pipelines, right, which are really the critical infrastructure to move the gas and oil around. And now we're exporting more and more of our energy, especially this liquefied natural gas, to Europe. So that infrastructure is really critical. I think we're just in the beginning stages now, Jonathan, of an increase in capital investment, an increase in production in energy in the U.S., right? What we've seen in the oil curve is, yeah, the front end contracts are coming down, but the curve is more evenly balanced. So that's actually incentivizing oil companies now to produce a little bit more. it's actually a really good environment for energy credit investors.
Bouncing on that level.
It just means more cash flow for more years to come.
Mike, where do you stand on credit risk more broadly? A lot of people have still been quite comfortable with that. Looking at the numbers from payrolls this morning, the jobs data looks fantastic. The American economy, for many people, looks robust, resilient. Do you fear the slowdown in the back half that some people do?
Absolutely. You know, Jonathan, the economy is red hot. The labor market is red hot. But all of those things always occur right before a slowdown, right? You get a flat curve, you get a really low unemployment rate. In fact, that's actually one of the best leading indicators of future
push up again on gold. Look,
a really low unemployment rate,
going to reject
really hot
trend
economies,
line,
and we are there, right? But I think we're just at the tipping point now, Jonathan, where we're going to see this
in the neutral
inflation
zone. You can
start to,
see candles follow.
generate demand destruction, right? So I really think the second half of the year could be a lot weaker, and I worry about this first quarter earnings season, which begins in the next week or so. I think you're going to see more profit warnings, more profit margin warnings, more uncertainty.
So we're going in on
a company's inability to pass
West
through
30,
costs.
which should push back down. It is doing as gold's going up. It's amazing to see them way.
Your view on the data and whether you share those fears that Mike has.
It wants to get back into our breakout zone.
Ignore the data, and I think Mike is absolutely right that it's not just the yield curve that's really
I don't know
setting
where
some
go.
warning flags here. I think it's the fact
Anything,
that
predicting
wage
anything.
growth is not keeping up with inflation.
Not any
It's
financial
not
advice.
keeping
This is
up
the
with
way I
wage
like to
coming
scalp.
through, and it's biting the consumer. And speaking of the oil markets, we're already seeing a slowdown in some of the oil demand this year, where seasonally it should be picking up. I do have the same concerns about the data. I don't think the slowdown is imminent, but it should definitely be watched.
Anastasia Amoroso sticking with us alongside Mike Collins. The data absolutely stunning this morning. Fantastic. Slight miss on a headline number, but everywhere else, unemployment much lower than anticipated. Year-over-year wages looking decent, and the move in the bond market up 11 basis points on a 2-year this morning. Your 2-year 244, and your 10-year right now higher by 9 basis points to 243. Coming up, the morning calls, and later, it's day one of Q2. Equities coming off their biggest quarterly decline since the pandemic. That conversation just around the corner.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers.
2 minutes to go.
For SpiceJet, because it is the
Load it up
only
again.
operator of Boeing 737 MAX planes currently.
Stocked early enough all these precious materials you were just mentioning,
Boom.
and we were on the lucky side.
US 30 pushing back down, so it's going to have it's forming a nice W. Beautiful. See, there's the M, W.
Material we would need and what
Little
quantity
pattern.
we would need.
Love it when we see these patterns forming. Come down to here. Or
The
And
job
diamond.
in America looks rock solid. About 5 minutes away from the opening bell. Equities are doing okay.
well, I suppose it could just drop, but I like seeing these patterns. I like to follow these second legs.
Trading above the 10-year yield. Post payrolls for much of the last hour. Right now, no different. 243 versus 242. Some curve inversion. That's the price action. Let's get you to your morning calls. We can kick things off with Citigroup upgrading Wynn Resorts to buy, expecting pent-up demand to drive a swift recovery in gaming throughout Macau. Your second call from Baird, downgrading Walgreens to neutral, seeing little upside amid weakening demand for COVID-related items. And finally, Goldman, downgrading Dow to neutral, highlighting the stock's recent outperformance and growing
Stocks, it's always good.
Negative 1.9% at 49.25. Coming up, looking ahead to Q2 after stocks record their first quarterly loss since 2020. I had to check that a few times. I can't believe that. The first quarterly loss going all the way back to the pandemic. Your opening bout to kick off Q2 is just around the corner. From New York City, this is Bloomberg.
Futures up. Is it going to be up? No. Down to me. Getting ready. The NY Open. Load up. US 30 on the chart. We can get. We've got about 30 seconds to go, as you can see. Watching this RSI, if it's going to kink up or it's going to drop down. We going on. Good luck, everybody. Final trades of the week coming up. We're going to get 100% out of the opens. Been successful on both opens, but it would be nice to finish off. They were sat on this resistance, support resistance, whichever it makes their minds up it's going to be in a minute. It's looking to the downside, but let's see. There it is. There's the RSI. There's the RSI pointing down. And we're in and we're out. Excellent. We get 71. Hey, $100. $100 on that move. Beautiful. That's what I'm talking about. Cool.
Which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
Oh, beautiful. Now,
collaborated with pretty much everybody who is involved in space exploration.
all we had to do was follow the RSI. True scalping can be so simple at times, you know. Break this zone.
If we want to have successful human missions to Mars,
Look.
we are going to have to learn to live and work off-world in a different
I'm
way.
going to push it any further. We can jump in again.
Going to learn to do that is on the moon.
Moving crazy. Good RSI's 31.
Its next giant leap.
Up them down again.
Access the
Gonna
financial
feel
world on demand. Hear from leading economists,
Just wait and watch.
policymakers,
No position.
and
Moment.
industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Okay, it's raining very nice. Be good. 31. Need to be 29.
It's really a reminder, isn't it, just how sensitive the market
Beautiful
is.
spike.
Any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Get gold. Gold shot up. With the reverse. So you could have gone for a buy on gold. Quick one though, because you say you were against some serious levels. Against all. You could have got 20. 50. I'd have gone for 10. 10 points would have done me.
Off the back of a really decent payrolls report in America. There's the opening bout, switch at the board and get to the bond market. Yields are higher.
In fact, it went the same way as the NFP. So I told you, usually we go reverse.
And some curve inversion through much of this morning, following that payrolls report. In the FX market, the dollar stronger, euro weaker, euro dollar down to 110.44, off by 0.2%.
That's pushing down.
Again, a 99 handle, 99.17, and down a little more than 1 full percentage point. That is some of the cross-asset price action about 20 seconds into this session. Let's see some movers. Here's Abby.
Oh, got a bull break on DAX. Very good. Back on US 30. So it's going to push down, fill that wick. And we're out, yes. 3 trades, yay. We got $12, $50 and $30, yay. So that is the open done. DAX is going the opposite way to us. And that's it. US Open done, NY Open done. And that's a 100% win rate. And everyone in the group will back that up today. On all London Opens and all New York Opens, we have successfully scalped and won at least $100 on each one. So that's just following the RSI. How you do it? This is true scalping. You haven't got time to go in and set levels. You can go in and set 50 to 100 pips. Points, sorry, 5 to 10 pips if you want. But also you can just jump in like me on this. Get the green and get out of there, you know, perfect. That's what true scalping is all about. So RSI is now back into a re-enter zone. Look at that, it's going down to a heavy support.
In terms of fixed income and equities, when it comes to U.S. assets, Treasuries, of course, saw their worst quarter on record.
So basically, the open has gone the way off the NFP result. Worse than expected. High inflation.
It was the worst return collectively since 1980. Of course, I left one thing out there, John, and that would be commodities. That was probably the best place to have your money. A hedge against inflation, seeing commodities rising across the board, 20% for the ags, 23% for the metals, and of course, when you combine oil and gas, broader energy up about 47%. That's all the backwards look, John. When it comes to the forwards look, and I'll focus on equities here and look at history, this was just the 9th time since the year 2000 that the S&P opened the year with a first quarter loss. Of the prior 8 years that happened, 6 of them actually saw rallies in the second quarter, gaining an average of a little more than 5%. So that could be a good signal, but the caveat here is in 4 of those years, the index still ended down on the year.
Beautiful.
Some important stats there. Back with us, Anastasia Amoroso, Mike Collins. Mike, I want to build up on
I'm
something.
going to post today's results into the trading group.
And it echoed something that David Kostin of Goldman Sachs said to us a little bit earlier this week. This is what he wrote. There's going to be a significant number of negative earnings surprises. In fact, you'll probably get a large number of pre-announcements in the coming weeks just before the earnings season. Can you weigh in on that, Mike, and where you think some of this is going to be concentrated?
Yeah, well, it's really a function, Jonathan, of the fact that something has to give, right? Either prices have to come down or demand has to come down or both, right? And I would guess by the end of the year, both are probably coming down. But companies are just getting to the point, this inflection point, where they're going to really have difficulty continuing to pass through these higher input costs. Right? So they either stop producing stuff or they eat it in terms of profit margin. And I think it's going to be pretty widespread, but it's really the consumer discretionary side, right? If people are spending all their money on oil and gas and cars and food, they're not going to be able to spend money on discretionary items. So I think there's going to be a lot of pushback from consumers.
RSI 24 is great.
The same pushback.
I am. In fact, if you look at one of the surveys, that
5 to 10, US 30 should be, and bounce off that heavy support.
But in the next 3 months, they're not
Got 2 minutes to go on this candle.
to the same extent as they have before. So I think that's exactly right. Is between slowing wage growth for the consumer and inflation that's starting to bite, and the companies that are not able to raise those prices as they have done before. I think that is going to produce a margin squeeze for some of the consumer staples and for some of the consumer discretionary companies. And broadly, I also agree with Mike that I think we're going to be in this period where we're going to see slower economic growth. We're going to see Fed rate hikes, and all in this is
going
going
crazy
to
here.
lead to an earnings downgrade cycle. We've already seen this, by the way. Again, if you look at the global earnings revisions ratio, it is dipped negative, and that usually doesn't flip back around very quickly.
Blue zone form now, you see.
So I think that's going to be the story for the
We know
rest
it's
of the
good to
year.
get out of a
But I will
trade.
come back to Q2
Size 26 look, 25, it's ranging, it's trying to push down.
are in for a better Q2 that we've seen in Q1, because we're going to see some of the reversals of the trends from Q1. But on earnings in particular, Mike is right. We have seen a great number of negative earnings pre-announcements. the greatest numbers since I think the fourth quarter before the pandemic, or 2020. So with that, maybe for this particular quarter, a lot of that negativity is starting to be priced in, and we're entering a seasonally strong period for the markets. So I probably wouldn't fade this rally just yet.
What would you do at the index level, Anastasia? This is the first time that you and I have talked in quite a while where you don't sound as constructive on the story at the moment, ex-energy. What would you do with the index story?
Just shows you how the bigger picture affects everything. An economic calendar basically gets chucked out the window. Even NFP, like you say, we've seen today small moves, not big massive moves, big massive giant spikes, because all this has been offset by the Russian news. And this is what you've got to take into consideration as a fundamental trader, you know.
And to propel the markets, and we have to contend with this growth slowdown. So
So we'll watch this. So we've been going 90 minutes. We've had a good, like I say, we've done about 35 trades, 2 losses today, well up. Another good session. London Open, NFP and New York Open. Posted the results into our trading group. Like I say,
and so maybe that's a way to give up some upside and give yourself, through the options
well done to all.
On the downside. That's one way to think about kind of moderating some of your risk on exposure. But then on the index level, yes, I would stick with the energy trade. I actually do like the tech trade. A lot of people flee that just because the Fed is raising rates. But when we are going to a growth slowdown, you want things that have the highest margin.
We just grabbed 2 sales on US 30 to end our live stream. That was another $40.
Some of the higher dividend payers. Rick Reader likes cash. I think there's definitely a place for that in the portfolio. And I think Rick also made a good point is with rates rising and credit spreads widening, that does start to change the dynamic for what investors want to do. So I think some value is also starting to emerge in the bond market as well.
In the day with, in the week with.
Around the equity story. I wonder whether real rates will be a supporting factor in the years still to come. City's Robert Buckland thinks so. He wrote this. He said the following. Negative US real yield should prop up global equity valuations despite intense geopolitical conflict, GDP cuts, EPS downgrades, runaway inflation, monetary tightening, positive real rates potentially coming into 2023 would make us less inclined to buy the dips. So the real rate story for him doesn't change until 23. Now, Mike, that's your world. Mike, what's going to happen with real rates through this year into next year? How are you positioned for that story?
Yeah, Jonathan, I think they basically stay negative for most of the rest of our lives, right? I think a negative, 0 to 1% real rate is actually normal in a world of tremendous demand, tremendous excess savings.
Saying thank you for everyone joining me.
Aging populations, you're supposed to pay to store your money in short-term risk-free assets, like you pay to store everything else.
I'll post my results on Instagram as well.
What could happen is the Fed could overhike, which is very likely, and probably
another
base case as inflation's falling, right? And then
successful
so maybe get a short period of positive real rate.
Like I say, just 2 losses out of 32 trades. Perfect. Like I say, if anyone wants to learn how to do this, to have access to our Axe trading system, have our team as your mentors, then go to www.mohawk.com. And yeah, that was a nice cheeky little sell there. Let's call that spike down onto the heavy support zone. Then out. Let's just flick back to gold.
And a real hawkish tilt to the Fed.
Perfect. On the open, we didn't trade gold on the open, but that is a good one. That went up and the steady went down. So yeah, the perfect reversal is what I like to see. But yeah, thanks to everyone for joining me. Give us a like if you like what we do. Obviously subscribe and share, tell people about it. And we shall do some more live streams next week, and I'll be in the group at the weekend doing some mentoring and teaching how to use this system. But yeah, just have a good weekend, everybody. Enjoy your trading, that's the key thing. Trade safe. See you on the next live stream. Take care all.